Most people think the most valuable thing a successful investor has is better information, better stock picks, better timing, better access to opportunities that ordinary people don't see. The assumption is that the gap between people who build serious wealth and people who don't is primarily about what they know or what they can access. But spend time actually studying how quietly successful investors think, not the ones performing wealth on social media, the ones actually building it, and a completely different picture emerges. The edge they're most protective of isn't a stock tip. It isn't a platform or a portfolio strategy. It's something that doesn't appear on any brokerage statement and can't be purchased through any financial product. It's time, specifically how they've structured their life to have more of it and how they've learned to make financial decisions that compound that time rather than consume it. And once you understand what they're actually doing with it, the entire conventional conversation about investment returns starts to look like it's been asking the wrong question from the beginning. The financial media has a singular obsession with returns. Which fund outperformed, which strategy beat the index, which investor called the market correctly. The implicit message is that the path to building wealth is finding a slightly better return than everyone else. And returns matter. Nobody is suggesting they don't. But the conversation about returns almost always ignores a variable that, over a long enough timeline, makes the difference between return rates look almost trivial by comparison. That variable is time in the market. Not just starting early, which is the standard advice, but structurally creating a life where financial progress doesn't depend on your constant, active attention, where money is working while you're doing other things, and where the compounding process never gets interrupted by the urgency of immediate needs. The investors who understand this aren't trying to find a 12% return when the market offers 8%. They're trying to build a life where the 8% runs uninterrupted for 30 years without being derailed by an emergency withdrawal, a debt spiral, a career crisis, or the emotional panic of a market correction. Because an uninterrupted 8% over 30 years does something that an occasionally interrupted 12% almost never manages to match. And that's the insight most people miss entirely. Time arbitrage, at its core, is the practice of structuring decisions today in ways that protect and extend the uninterrupted compounding window of tomorrow. It sounds abstract until you see what interruptions actually cost. Consider someone who starts investing at 25 with $400 a month into a diversified portfolio. At an average annual return of 7%, that grows to somewhere around $1.1 million by age 65. 40 years of uninterrupted compounding. Now introduce 3 interruptions, 3 moments across those 40 years where circumstances force a withdrawal or a pause in contributions. A job loss at 32 that drains the account. A debt crisis at 41 that requires pausing contributions for 2 years. A medical expense at 53 that pulls out a significant portion. Each interruption felt necessary in the moment, each one in isolation seemed manageable. But the compounding that was lost during those interruptions, the growth that would have built on top of the money withdrawn for the remaining decades, doesn't come back. It simply doesn't exist. The final number at 65 might be $600,000 to $700,000 instead of $1.1 million. Not because the returns were worse, because the continuity was broken. This is why the most sophisticated long-term investors are obsessively focused on things that appear to have nothing to do with investing. The emergency fund that means they never have to touch the portfolio in a crisis. the low, fixed-cost lifestyle that means a job loss doesn't require a withdrawal, the avoidance of high-interest debt that would otherwise compete with investment contributions for the same dollars, the career diversification that reduces the risk of income interruption. These aren't lifestyle choices separate from investment strategy. They are the investment strategy. They're the structural decisions that protect the compounding window from the interruptions that quietly destroy more wealth than suboptimal returns ever could. There's also a second dimension to time arbitrage that goes beyond protecting the portfolio. It's about purchasing time itself, the hours and attention that get redirected toward either consumption or creation, depending on how the financial structure is built. The investors who compound most effectively over long periods tend to have built financial structures that free their time and cognitive bandwidth from constant money management and money stress. They're not spending mental energy on which expense to defer this month or how to cover next month's shortfall. That freed attention gets redirected toward better decisions, better opportunities, better work, which feeds back into the financial system in ways that compound alongside the portfolio returns. Time that isn't consumed by financial stress is time available for the thinking, the relationships, and the decisions that generate the next layer of compounding. That feedback loop is invisible in standard return calculations and enormously powerful in real financial outcomes. Here's the reframe that shifts everything. Most people evaluate their financial health by looking at the investment account, the balance, the return percentage, whether it's up or down this quarter. But the investors who build the most over time evaluate their financial health by looking at the structure surrounding the investment account. How protected is the continuity? How many months could the life function without touching the portfolio? How low are the fixed obligations that could force a withdrawal during a downturn? How resilient is the income against interruption? These questions don't appear on any brokerage dashboard, but the answers to them determine whether the return inside the account gets to run uninterrupted for 30 years or gets broken 3 times along the way and arrives at retirement at roughly half the destination. The portfolio is the engine. The structure around it is the protection that lets the engine run. Both matter, only one gets the attention. The practical application starts not with the investment account, but with the structure around it. The first question is continuity protection. How many months of expenses exist in accessible form outside the portfolio, such that a crisis or income disruption doesn't require touching the investments? 3 months is minimum. 6 is meaningfully safer. Beyond 6, the returns available elsewhere start to outweigh the additional continuity protection. The second question is obligation risk. What fixed monthly commitments exist that could, in a worst-case income scenario, force a portfolio withdrawal to cover? High fixed obligations are continuity threats. Reducing them systematically over time reduces the number of scenarios in which the compounding window gets interrupted. The third question is the simplest and in some ways the most clarifying. Of the money currently inside the investment account, what percentage has been there for more than 5 years without interruption? That percentage is a rough proxy for how much of the compounding potential has been protected versus how much has been broken by the circumstances the structure failed to absorb. Most people find that number humbling and then useful. The investors who build the most wealth over a lifetime aren't the ones who found the best returns. They're the ones who protected the continuity of ordinary returns long enough for compounding to do what compounding does when it's left alone. That's not a secret available only to sophisticated professionals. It's a structural discipline available to anyone willing to think about financial life as something to be protected, not just optimized. The market will do what it does. The returns will be what they are. The one variable that remains most in your control, the length and continuity of the window, is the one that ultimately matters most. Protect the window. Everything inside it will take care of the rest.